You can put pretty much anything on a deal evaluation sheet. The question is, are those numbers real? Do they really hold? Do you know your market? Do you know your numbers? Where are your numbers coming from? And at the end of the day, if the data that doesn't make it up isn't real, then the experience won't match. So we are breaking down a deal sheet from a Memphis turnkey rental property provider, or so they say. And we're going to pass it through old GC's Genius Concepts brain over here to see how good the deal sheet is and then compare that to Jacksonville numbers once we make it real. That being said, these are real numbers that we're talking about here on spreadsheets, but this is not financial advice. Do your own due diligence. What else am I missing in this qualifier?
Not financial advisors.
We're not
just real estate investors, been doing it for 20 plus years.
That's right. So that being said, 7 things to watch out on a rental property pro forma. Every time we break down these deal sheets, we go over this, right? We've seen over and over the fact that a lot of these pro formas don't include or underrepresent maintenance costs, vacancy costs. They also tend to underrepresent interest rates, down payments, and closing costs. They don't include or underrepresent property management fees, projecting higher home price appreciation or rent price appreciation. They don't include or underrepresent selling costs. And then they inflate the return on investment calculations by including tax savings, principal paydown, and or home price appreciation in year 1. So let's jump into the specifics of this property deal sheet. So this is a turnkey property in Memphis, Tennessee. This is being actively advertised and sold on the internet. We got this off of somebody's active webpage right now. This is a new construction home in Memphis, Tennessee, with a purchase price of $196,600, property taxes of $1,966 a year, household income of $100,000. Rent increases, assuming 3% rent increases, new construction appreciation of 4%, tax increase of 3%, lease renewal fee of $200, insurance year 1 of $768, a vacancy rate of 5%, 4% appreciation, 5% maintenance, resident placement fee of 50% or 1 month's rate, and a management fee of 5%. I see that you highlighted rent increase, new construction appreciation, resident placement fee, and management fee. Can you talk me through why you have these highlighted in the first?
Absolutely. Yeah. These are the things that I wanted to point out. Let's start with this appreciation thing. We've done this probably, I don't know, 5-8 times now. Have you ever seen a new construction appreciation and a normal appreciation rate there?
I have never seen a broken out home price appreciation for new construction.
But this is a unique thing that I have seen. They're counting home price appreciation for new construction properties at double the rate of existing inventory. And it just isn't very apparent here, but as I broke down their pro forma, they're actually counting 8% home price appreciation for the new construction home and 4% home price appreciation if this was an existing inventory home. This happens to be new construction. So it's a little sneaky way to put, you don't put 8% home price appreciation.
Yeah, so nobody bats an eye.
You put 4% for regular standard appreciation and then like a 4% bump on top of that to new construction appreciation. Doesn't jive with me. Doesn't make any sense. To think that a home in Memphis, Tennessee is going to appreciate 8% a year for the next 10 years is extremely, extremely unlikely. The Memphis historically accurate average annual home price appreciation rate is 3.2%.
So it's not even the 4% that is the baseline.
Not even 4%.
Okay.
So that's looking back over 40 years and seeing what Memphis's home prices have done, which is likely to be what Memphis's home prices will do over the next 10 years, 20 years, however long this is held. So way overestimated on home price appreciation.
So from 8% down to 3.1%, 3.2%.
Yes,
okay.
Exactly. And then on the rent side, I did the research. The average historical annual rent price appreciation for Memphis is actually 3.4%. So we see this often as well. Some, providers just don't know their market as well, don't have access to the same data. But yeah, so they actually underestimated their rent growth. It would be accurate to put 3.4 there, which would actually increase their return on investment, but they're underestimating there.
Okay. All right. Why'd you highlight the resident placement fee of 50% of 1 month rent and the management fee?
Well, so I highlighted this because what you're going to see is that this property management company focuses on 1-year leases. And so one thing to watch out for when you're making a decision with property management is you can go for the low cost, which is maybe a 50% placement fee, 50% of the first month's rent. Whereas a premium provider like JWB, we charge 1 month's rent.
Mhm.
But the reason there's value there is because we sign 2 and 3 year leases,
Mhm.
and our average duration of a resident stay is 4.5 years. So if what you're going to see here is that they have a lease renewal fee and probably will have more property turn costs down the line because they only sign 1 year leases. So be aware, if you're only signing 1 year leases, you're setting yourself up for higher maintenance costs. That's what I wanted to point out there. But here's an example where 50% of the first month's rent is being charged for tenant placement fees. And that is also very common in the industry to sign 1 year leases and 50% of tenant placement fee, but it usually doesn't work to your benefit.
The 5% management fee, GC. I've gotten to know the property management industry and I go to all these different conferences and whatnot. I meet very few people at conferences that are charging 5%. They're more like complaining about people charging 5%.
So you're right. Hard to run a premium property management company and deliver a wonderful experience to a client if you're only charging 5%. Industry standards 10%. What's going on here is this is an incentive that they're offering.
Okay.
The way that they're probably thinking about this is they're offering certain incentives to get people to be able to buy their homes. And it's just a marketing thing.
So that was like the deal sheet that the cover page, right? This is now looking deeper into the numbers. They have year one cash flow of $487 a month, a total IRR of 13.67% with a down payment of $60,073, year one NOI of almost 14 grand with a monthly mortgage of $791. And then I'm not going to read all these numbers, but you have highlighted here the annual property management fee as something that goes from $876 to $866 to $892 to $919 to $946 years 1 through 5. Maintenance and repairs that goes from 0 year 1 to $456, $469, $484, $498 in years 2 through 5. And then resident placement / lease renewal fees that in year 1 are $738, then $200, then $806, then $200. You want to talk me through some of these numbers that you've highlighted, GC?
Yeah, absolutely. So starting at the top here, when I looked at $487 a month in cash flow and IRR of 13.7%, to me, my first thought is, wow, this isn't the worst that I've seen. You know, a lot of times when we're doing these types of pro forma breakdowns, we see 20% IRRs and 25% IRRs. And so the biggest thing that jumped out to me is at least they understand how to do a pro forma. When you're buying a single family rental property, if you have IRRs that are over 15%, there's probably something wrong. It's probably some incorrect assumption, way overstating home price appreciation, way overstating the timing of home price appreciation, whatever. So to be in the 14% range, which they are here, I thought that was a good starting point. Now there's a lot of things that are incorrect, unfortunately, in the pro forma, which we'll get at, but ultimately those top line numbers there are somewhat realistic and believable, which I think is a good thing as they're selling properties to their clients. So I did want to focus on maintenance and repairs here, and then also the tenant placement and the lease renewal fees, because these are really related. We were just talking about the fact that they sign 1 year leases. I know this because if you look in year 1, they have a tenant placement fee of $738.
$738.
Year 2, you see $200. So that's their lease renewal fee. So they are hoping to renew in year 2.
Yep.
What happens if they don't renew in year 2?
Then you have a turn.
You have a turn.
Paint the walls.
Right.
Maybe replace the flooring. Yep.
Same thing for year 3. They're hoping to get the resident to sign another renewal. The resident's not locked into anything. They can make a decision to move. So they're assuming that they're going to get them to re-sign. Again, if they had signed long-term leases in the beginning, the resident is already signed up for 3 years. It's not a question if they're going to be there for 3 years. Now there has to be an independent decision. And so then what they assume is that in year 4, that resident is going to leave and they're going to charge another tenant placement fee. And then in year 5, the cycle begins again with a lease renewal at $200. But many individual decisions have to be made by that resident to want to sign up again. And that's a big if. It should all make sense. They should have a very high lease renewal percentage rate. It's not so much what's the fee of lease renewals. Think about what the effect is if and when that lease renewal doesn't happen like it shows on this spreadsheet. And that shows up under maintenance and repairs. To think that every time your resident leaves and you put a new one in, that there's not going to be maintenance costs in that year is not real. It's just not. You're going to put money into the property when that happens. So that's not there. I think it's also super aggressive to not put any other spikes in a 5-year period, knowing you're only signing 1-year leases.
Yep.
So that kind of getting to the point that I was just making.
Yep.
But here's the kicker. I know you can't do the math in your head right there, but they're only assuming a 2.5% maintenance cost throughout the entire 5 years of owning that property. I have never seen documented evidence of a 2.5% average maintenance cost for new construction homes or renovated homes or any type of homes over a large period of properties, right? It just doesn't, it's just not that way. JWB's maintenance is 4% for new construction homes. And so to look at that and say, well, number one, probably aggressive because it's only counting 1-year leases. Number two, not showing any additional cost for the year that the resident is replaced, the new resident is put in, not showing any spike there. And then your baseline case is 2.5% maintenance cost over a 5-year window, to me seems like way artificially underrepresenting maintenance costs.
Okay, cool. So here we are on the next one. Do you see?
Let's start with tax savings. So tax savings are not straight line across the board. What you're doing is the years where you make more net rental income, you are saving more on taxes. The years where you make less net rental income, you're saving less on taxes. In fact, if you don't make any net rental income in a year on a projection, which is possible in a year, maybe you have a property turn, at that point, you're not receiving any tax savings that year because you don't save taxes when you show a net rental income loss. So just to know here, in a single family rental property, if you just see straight line the same number across tax savings, that's not an accurate calculation for it. So that's the first thing. What's happening here is they're likely doubling the tax benefits as well. This is also a very common thing. They basically assume that you are getting a much larger write-off than you really are. And I won't get into all the taxes. I tried to figure it out, and it's just not completely accurate. Your tax savings actually go up and down over the years that you hold it based on what your net rental income numbers are for those years.
Good stuff. So let's talk about this loan payout amount, home sales revenue, selling, holding, closing costs.
Yeah. So here's where it got really funky. So thinking about principal paydown, they say loan payoff amount here. When you're thinking about building a pro forma, you gotta think about, okay, what amount of gain do I get and when does it hit my bank account? So when you actually are putting together a pro forma for and showing a principal paydown effect, the money that came to you as the loan never hit your bank account. So it's not like you get an infusion of cash when you receive a loan on the property. And also when you pay the loan off, it's not a, exit of cash from your bank account. It's just the loan happened. What's happening is you get a benefit from the loan pay down from your tenant or your resident paying that loan down for you. And so
you get that back when you sell as like extra profit.
Exactly. So what they have here is this $119,000 as a cost at that point, which doesn't make any sense when you're running a pro forma. I think they're just confused because that's not, while that is the loan payoff amount at that moment, that doesn't affect your pro forma. It didn't hit your bank account one way or another.
The loan isn't added in on the front end.
Exactly.
In these numbers.
Exactly. So it's actually like a cost here, which is actually bringing their IRR down.
Okay.
Which is, again, doesn't make any sense to me. I actually ran what the principal paydown amount should be. And there's actually about $27,000 of principal paydown gain. So that negative 119 should actually be 27,000 positive instead of a $119,000 loss. So in this section right here, it's actually way lowering what their IRR projection is, but don't worry, they're going to inflate it somewhere else. So.
All right. Home sales revenue. Why do you have that highlighted?
Well, here's just where you're incorrect and you're way overestimating on home price appreciation. So get this, you remember they talked about new construction home price appreciation in Memphis for this property being 8% home price appreciation per year. Well, I ran the numbers and that shows like a gain of revenue of $256,000 and change.
I would assume that that's the sales price when you sell.
But it's not. It's not. So if this is a pro forma, you shouldn't be showing revenue here. You should be showing your profit. Remember, when you're building a pro forma, it's all about how much profit did you make or loss did you make and when did it hit your bank account. So to calculate your home price appreciation effect, you look at the additive home price appreciation that hits when you sell in year 10. So they're confusing this again. They're putting home sales revenue, which makes me think of sales price, but it doesn't make any sense. In fact, when I actually ran the numbers, the sales price that they're assuming is actually $453,000 in order to put $256,000 of profit in your bank account when you sell. So they're screwing this up. And that, to make it even worse, that $453,000 number isn't even 8% home price appreciation. It's 8.7% home price appreciation, gaining year over year and compounding over 10 years. So the number's not right. But this, you know how we talked about how they're way underrepresenting the principal paydown component?
Yeah.
They are way overestimating the home price appreciation effect here by assuming that it's going to appreciate 8.7% per year. Again, like we talked about, the data says that historically Memphis has appreciated at a 3.2% rate year over year for average appreciation. So way overestimating home price appreciation here and just doing it incorrectly on what the pro forma should be built like.
Okay. And then selling and holding cost of $15K seems pretty low.
Yeah. So I ran that. If what they are assuming is a sales price of $453,000 in order for this to be accurate, and if you assume only 15 grand in costs, that's just 3.4%. What's a typical real estate commission?
6%.
There you go. So they're only assuming 3.4%, and that's not even counting your full real estate commission of 6%. Plus, you generally want to set aside 2% for closing costs on the sale and 2% for holding costs on the sale. So a 10% figure is what you should be accounting for. They only accounted for 3.4% here.
Now the big thing is, in comparison to a JWB turnkey property, which is initial investment of $65,000, $5,000 more, right? Net rental income, $17,900. So that's $9,000 and change less rental income over the 10 years, right? Tax savings about equal, right? $6,000 in tax savings. Principal pay down, slightly higher principal pay down. Home price appreciation of $136,000. And that's kind of like the big difference here, right? Even though less cash flow month to month, your total profits in a Jacksonville investment over 10 years, $154,000 versus that $97,000. That's $57,000 more over 10 years in one property.
Yeah, exactly. There are pros and cons to each property, but at the end of the day, you have an ability to spend $5,000 more, earn a little bit less cash flow in the intermediary, and then make $57,000 more down the line. Maybe that's the right call for an investor out there. If you are an investor who wants maximum cash flow, then you might say, well, I'll spend $5,000 less. I might get $10,000 more of cash flow, but I'm going to leave a lot of home price appreciation on the table at the end of 10 years. That's why somebody would decide to go the Memphis route. JWB clients want the best of both worlds, which is you still get a lot of positive cash flow. It's not going to be $450 day one. It might be $200 a month in day one. But ultimately, at the end of the day, your rate of return on the dollars that you put out is much higher when you have both positive cash flow and significant home price growth over 10 years.
You see, I'm a buy and hold guy, right? So I'm not liquidating my property in 10 years, right? So like this idea of like, I'm going to have $57,000 more in my pocket, not super real to me. But what is real to me is the idea that $57,000 of extra profits is pretty close to the down payment of cash out, like a cash out refi that buys me another rental property and allows me to continue to grow my portfolio, right?
That's how we change your life. That rhythm right there of buying an asset that pays for itself every single month, produces positive cash flow. You let all these wonderful things happen in the background, including home price appreciation. You get into a rhythm of maybe every 5 to 7 years, unlocking that equity and then having it create property babies and create assets that you are just reinvesting your own profits into. And that's how you go from a portfolio of 3 properties to 5 properties, 10 properties, 20 properties, but you didn't have to bring your own money to the table to do it. And that's how we can really, really change your life. So this model that we've really espoused and gotten a little bit more loud about of harvesting this equity, redeploying it, that's where a market like Jacksonville, which has higher than normal home price appreciation, is really built for that type of a model.